Hello friends, welcome to wisdomjobs.com. This is Prithvidhar Reddy. We are going to discuss the budget for the financial year 2020-21. Coming to the income and expenditure side of the budget. So if you try to trace out, how the rupee is coming, how the rupee is going. This is very important analytical chart which is published by the Press Information Bureau. So actually the corporation tax, which is out of the 100 paisa, it constitutes 18 paisa, and next amount is 17 paisa out of the income tax. In the questions in the examination it may come that whether the income tax is more than the corporation tax or corporation tax is more than the income tax. What is the answer? The corporation tax is more major income source compared to the income tax for the government. So next important tax is GST. So that is, it is in the same equation with the corporation tax. Coming to the non-tax revenues, that is about 10 paisa, and excise duty is 7 paisa, and important thing is non-debt capital receipts is 6 paisa, because in the name of selling the governmental assets and getting the dividends from the public sector undertakings, and the borrowing of the government is 20 paisa. You can understand it is almost all 20 paisa. It is 20% of the government finances are actually sourced from the borrowing. And coming to other expenditures, so where the pensions are constituting 6 paisa, okay, and subsidies are constituting 6 paisa, because the pensions and subsidies are actually on the equal footing, and the defense is getting 8 paisa. Centrally sponsored schemes, so like MG Narega, Prime Minister Awas Yojana, in that way those schemes are sponsored by the central government, so which will actually attract 9 paisa from the government. And coming to the Finance Commission and other transfers, Finance Commission actually recommends the transfers from the Government of India to the various state governments. So that amounts to be 10 paisa. And the central sector schemes, that is 13 paisa, like Pradhan Mantri Sadak Yojana, in that way. And coming to interest payments, that is 18 paisa. And the state share of the taxes and duties, it is 20 paisa. So this is the balanced picture, how it is emerging from the budget for the 2020-21. So if we have a budget for a glance, so for example the revenue receipts, if we try to take the revenue receipts, so revenue receipts are actually estimated for the year 2020-21 is 20,20,926 crores. But coming to the year 2019-20, so it was actually, the actual receipts include 18,50,101 crore, but the budgeted estimates were 19,62,761 crores. It means there is a serious shortfall on part of the revenue receipts by the Government of India, which has impacted the Government of India very much seriously. So let us see whether this target in the year 2020-21 is achievable or not, because the economic growth is going sub 5%. So definitely the government finances are being affected very severely. Coming to the capital receipts, so in this budget it is amounted that 10,21,304 crores must be gotten from the revenue receipts. But compared to the last year, for example, in the year 2019-20, the budgetary estimates were 8,23,588 crore. But in fact, what was the realized amount? 8,48,451 crores. So there is an incremental value. On the capital side, the 2019-20 budget was faring very good. Coming to the expenditure side, the revenue expenditure for this year is actually budgeted for 26,30,145 crore. So whereas coming to the last year budget, that is 2019-20 budget, the budgetary estimates, which include 24,47,780 crores, but the realized expenditure was 23,49,645 crore, almost all 1 lakh difference. So it means the government failed to spend the money as it was budgeted in the budget. Coming to the capital expenditure, so it was budgeted for 4,12,085 crores, but in fact what happened in the previous financial year? So the original estimates of the 2019-20 budget was 3,38,569 crore, but the realized amount was 3,48,907 crore. So it means there is an increment in the capital expenditure. So it means on the capital side of the expenditure, the government could receive the targets. So this is what the very important signal the budget has given. Coming to the deficit trends. What is the deficit? You know, the borrowing liability of the government is nothing but fiscal deficit. So coming to the fiscal deficit, so it was actually this question, this is very important trend which is generally asked in the examination. In the year 2018-19, it was 3.4% of the GDP, and later it declined by 1 point, that is 3.3%. Later it again increased to 3.8%. Now it is targeted for 3.5%. Let us see whether the government can keep up this 3.5 target. And revenue deficit, it is 2.4% in the year 2018-19, and later it got 2.3%, and later it got 2.4%, and now the budgetary target is 2.7%. Coming to effective revenue deficit. Effective revenue deficit means these are the transfers made by the government of India to the states, because the central government will give grants in aid to the states. So grants in aid to the states means these are not the loans which are given to the states. These monies cannot be given back to the central government again. If the states are using these grants in aid, okay, for the creation of the productive assets, so definitely what happens, the revenue deficit, from the revenue deficit you must deduce the amount which is used for the capital creation. So that eventuality is known as effective revenue deficit. So that is actually targeted for 1.8% this year, which was almost all in the same rate all these years from 2018 to 19 to till 2019-20. So all is on the same particular rate, that is 1.4, 1.5, 1.5. Now it is amounted for 1.8. And coming to primary deficit, deducting the requirement of the interest payments from the borrowing liability, that is the fiscal deficit. So fiscal deficit minus interest payments is known as primary deficit. This is actually on the declining mode, because in the year 2019-20 it actually raised to the level of 0.7%. Now it is targeted for 0.4%, okay, of the GDP. That is a good signal coming out of the budget. Coming to the tax receipts, the tax revenues are just 16,35,909 crore, which means only 53.7% of the government's expenditure. And the finance minister estimates the tax revenue could be 16.35 lakh crore, and the government also gets the non-tax revenue receipts, so that amounts to 3.85 lakh crore. Okay, so tax revenues are more than the non-tax revenues. So this is the important observation. So again, coming to what are the revenue receipts, because we must understand the tax revenues include taxes and duties, and non-tax revenues include interest on loans, grants in aid from the foreign bodies, and grants in aids means, you know, you need not repay the amount which you have gotten from the other institutions. Payment for the services like railway ticket fares, etc. Dividends from the investment. Okay. Coming to the capital receipts, the loans raised by the government from public banks, RBI, selling of the public sector shares, not only that, selling of treasury bonds, foreign entities via external commercial borrowings. These are all the capital receipts. Money received by selling of the shares of the PSU, and recoveries of the loans given by the central government, small savings, post office credit and provident fund. These all come under the capital receipts. So coming to the major share of the capital receipts come from the disinvestment target, because the disinvestment is nothing but selling of the government shares, the public sector undertaking shares into the market, especially to the private sector or government sector as well. So that is known as disinvestment. So the finance minister limited the borrowings to 7.7 lakh crore, so that is 3.5% of the GDP. So expecting additional revenue via another route, that is the sale of the capital assets. So it means the capital assets must be liquidated to get the required revenue, the required resources for the government. If the government is not able to raise the money from the disinvestment process, the government has to raise the borrowing limit. So that is dangerous for the economy as well. This government has set an ambitious target of sales of shares of public sector companies, which are valuing around 2.1 lakh crores. The issue which is getting more public attention is the government is going to sell the shares of the Life Insurance Corporation of India. So this is getting the major public attention. It is profit making company, and when the government is liquidating the assets of the LIC, definitely it is a kind of loss to the people. Previous government has not touched this insurance sector because this is the insurance cash cow, and probably reserving it is only for the emergency situations. It means you are selling the family gold. So this is nothing but, I mean, it means the selling of the LIC shares is nothing but selling the family gold. So it must be done only in the emergency situations. So now the government is going to liquidate the shares of the LIC. Coming to capital receipts, so this year the capital receipts are actually targeted for 2,24,967 crore. Out of this, from the disinvestment, how much money is coming? 2,10,000 crores. So from the receipts, I mean other than the tax and non-tax receipts, so the amount is 22,45,893 crores. The borrowings would be 7,96,337 crore. So it means this includes the revenue and capital receipts excluding the borrowings. The borrowings would be 7,96,337 crore, and the total receipts will include 30,42,230 crores, which is the overall size of the budget. The trends in the tax receipts. Actually, if you try to understand the trends in the tax receipts, the gross tax revenue as a percentage of the GDP is just 10.8%. So which is compared to the developed countries, this figure is quite low. For example, America, China and other countries, their gross tax revenues would be more than 10 percentage points. So now our tax revenue is just hanging in the range of 10.8% of the GDP. So coming to the direct taxes, the direct taxes constitute 5.9% of the GDP. So compared to the indirect taxes, which may constitute 4.9% of the GDP. So in this way, the budget is a progressive budget because we are sourcing more resources from the rich people compared to the poorer and vulnerable sections. But still this figure is not good because 4.9% is not good. So it must be reduced further, and the revenue from the direct taxes must be increased further. Coming to the subsidies in the budget, the general subsidy proportion in the budget in the year 2019-20 was very much higher. Okay, these were the budgetary estimates. So higher for food, next comes fertilizers, next come petroleum. Okay, but in the realization, the food subsidies were further reduced. Okay, revised according to the revised estimates, because the government revenues were in the severe shortfall because the government was compelled to reduce the subsidies to the various sectors. So the food subsidies were drastically reduced, okay, compared to the subsidies of other sectors. And coming to the interest rates, okay, this is the another important liability on part of the government. Coming to the figures of the expenditure on various sectors. First one, pension, it is about 2 lakh crores. Next comes into defense sector, it is about 3 lakh 23,053 crores, and major subsidies amount to 2 lakh 27,794 crores, that is fertilizers, food, petroleum, etc. Agriculture and other activities 1 lakh 54,775 crores, and commerce and industry 27,227 crores. In that way, there are various allocations to various sectors. Coming to social welfare, 53,870 crore, tax administration 1,52,962 crores, transfer to states it is more than 2 lakh crores, and IT and telecom 59,349 crore, planning and statistics 6,094 crores for various departments. Okay, these were the allocations. This is for the various important sectors. Coming to the major achievements of the Indian economy. So in the budget it was given that India is now the 5th largest economy of the world, and 7.4 average growth clocked during the year 2014 to 19, with inflation averaging around 4.5%, and 279 million people raised out of the poverty during the year 2006 to 2016, and India's foreign direct investment elevated to $284 billion during 2014 to 19. So from $190 billion during 2009 to 14. This is the major shift with respect to the foreign exchange reserves. Central government debt reduced to 48.7% of the GDP from 52.2%. Okay, this is the major shift from the debt to GDP ratio. The two cross-cutting developments include the proliferation of the technologies, that is analytics, machine learning, robotics, bioinformatics and artificial intelligence. So these technologies are actually expanding and proliferating very much in India. Highest ever number of the people in the productive age group, that is the productive age group include 15 to 65 years. So this is very much high in India. And the GST removed many bottlenecks in the system. These are the major achievements of the Indian economy during the year 2014 to 19. Coming to the basic balance sheet of the budget, how the budget is there. So one important clue from this year budget is that falling tax revenue. So even the government has lowered its expectation on the tax revenue when compared to the last year. The tax revenue along with the non-tax revenue only helping to meet 2/3 of the expenditure. Remaining 1/3 of the expenditure is actually sourced from other sources and in the name of borrowing, as well as the disinvestment process. It means the government assets are being sold or the government is raising the loans from the market, and the economy is facing slowdown. The government cannot expect much from the income tax. Okay, so that's why the GST still has many bottlenecks to be fixed, because the GST is also not faring well. And to fill this gap, the government is depending more upon the disinvestments. It means the government is aiming more than 2 lakh crores from the disinvestment process and as well as the market borrowings. So it is about in the tune of 7 lakh crores. Okay, and to get out of this current economic slowdown, increase in fiscal spending the government in the priority areas is the highest solution. Of course, nevertheless, it is clear that too much borrowing will widen the fiscal deficit, because the fiscal deficit is not good for the economy. Definitely it will distort the investment climate in the economy, and it may also increase the inflationary tendencies. So it is also against the FRBM guidelines which was enacted in the year 2003, but the government is now going in that direction. So this is a problem with respect to current budget. Another indicator in the budget is that the FRBM Act says that the revenue deficit must be just 0, but the government is increasing the revenue deficit from previous 2.4% to the currently 2.7%, which is targeted in the budget. Instead of increasing spending at the capital asset side, there is an increase in expenditure on the revenue side this year, which will surely create the problems for the future. Because when you are not investing on the assets, definitely it will not help the economy. If you are spending more on the jobs, more on the salaries, more on the pensions, more on the unnecessary expenditure, definitely it will not help the economy as well as the government finances. So what the government has to do? Because the government should do, it must promote a good business atmosphere in India so that tax revenue will increase accordingly, and otherwise the revised budget estimates will show the targets missed. Definitely what happens if the government revenues are falling short, definitely the government has to borrow more, and if this is the case, there won't be enough funds for the development projects and promises, which will remain only on the paper. So this is going to happen if the budgetary targets are missed. So last but not least, over dependence on the borrowing and disinvestment is not good sign of the healthy economy, because enlarging deficits just shows that things are not well. Because the disinvestment is nothing but selling your family gold. Borrowing means nothing but you are going to meet the government expenditure only by the liabilities. So probably these measures can be used as a temporary medicine until the economy bounces back. However, we cannot do it year after year. Thank you friends, thank you for watching this video. If you like this video, please press the like button and don't forget to subscribe to wisdomjobs.com.